I was hoping to do is walk through the panel, have the panelists introduce themselves to you, give you a bit about their background, and then let you know their sort of quick from the top sense of where we are as an industry. Why don't we start with you, Jeff?
My name is Geoffrey Duyk. I'm a physician and scientist by training, starting out as an academic at Harvard Medical School, where by a series of circumstances that are hard to recapitulate, I ended up as one of the founding scientific group at Millennium, where I was there for 4 years as a VP of research. Went on to help restart a company called Exelixis, where I was president and CSO, which I think is in the sort of this late 90s generation of companies, was also quite successful. I left Exelixis late last year, or announced I was leaving, and currently work at TPG Ventures as a partner, where I spend about 80% of my time on the venture side and 20% on the LBO side, sort of a barbell type approach. In terms of biotech, where I think things are, I think it's both the best of times and the worst of times. I think there's a lot of macro aspects of the industry which play to the strengths of biotech, assuming biotech can get its act together. It's a very capital-intensive process which requires not single technologies but integrative capability. I think we're also 15 years into a technology cycle, and my experience has been it takes about 20 years to reduce technology to practice. So we're right on the precipice of the point where the kinds of technologies which evolved over the last 20 years, if they can be put together and funded in a sustainable way, should produce highly valuable products. But the challenge will be and continue to be is cost of capital. The reason Millennium worked so well was that the pharmaceutical industry was willing to co-invest in speculative technology at a very early stage, where today people are not paying fair market value for your technology until you actually provide them with the output of technology. And sort of bridging the gap between those two things is really sort of what we need. And I'll leave you at one point. I've never seen a biotechnology company fail because of its technology. It generally fails because of a lack of a commercial savvy. And I think one of the things we really need in this industry is more people like you here in the audience thinking about ways of working with investors to try to work through these issues of difficulty of getting capital at a fair price.
Barbara.
My name is Barbara Santry, and I'm a venture capitalist at Capstone Ventures and have been there for about 11 years. Before that, I was a sell-side analyst for 9 years doing medical devices and healthcare services. And my core expertises are that I understand how markets respond to value-added products and how to position them, and have a particular expertise in the reimbursement component of how markets respond to new healthcare products. Got that by long service in the Medicaid administration so that I understand how payers think. And I was at one of the large hospital companies and have watched how technologies get absorbed by companies. I was originally a Navy nurse and was class of 78. And our view of this industry, both medical devices and biotech, is that we're in perhaps the best of times, but perhaps the worst of times. In our industry, the core way of building value is to get the public investor to take the risk early. And for a variety of reasons that predominantly have to do with medical device and biotech companies disappointing medical device companies on their rollouts and biotech companies on their clinical trials, the public investors are not interested in taking very much risk. And the result of that is that we're taking companies public in a much more mature stage. And as you saw from Mark's slides, the average company that's going public has $95 million in it. And the valuations in the public market don't change from time to time. They're about $250 to $350 million. And 450 if it's a stronger market. What changes is how much risk you can shift to the public investor. And we're in a place where the public investor is very much interested in seeing companies that have already performed. And we are coming out of a time when we focused on how good was the pitch and how could we shift the risk early. And we have not had a very good record recently with our companies out there performing. And the public investors are now waiting longer and longer. And that means what you saw on the slide, that much more money is going into the companies. And our model doesn't work very well when a lot of money has to come into the companies, particularly with respect to early stage. When a company goes public early, everybody converts into common, and then if anything goes wrong, it's evenly shared. If you are raising your clinical trial money or your launch money on the private market, the risk is disproportionately shifted to the entrepreneurs and the early stage people. And so that is a particular issue with early stage investing. So it's a time when value-added products are going to make people a lot of money, but we as an industry are in a transition of moving towards focusing on performance rather than pitch. And unfortunately, it'll take the public market a while to find out that we have successfully transformed. I believe we are more there than not there, but we probably have a couple more years before our model starts to work well.
Thank you.
Sure. My name is Craig Taylor, and I'm with Alloy Ventures, and I started out in physics and making little lasers, and came out to the West Coast because in the early 70s there were a lot of companies being started in the laser business, and I got fascinated with the fact that we could make these lasers but had no idea what to use them for. There were dozens of laser companies started. I ended up coming to the Stanford Business School, where I worked at the technology licensing office that was just getting started at that time, looking for things that were being developed in the labs that might be commercialized. I ended up joining a venture capitalist, a single-man firm, a fellow who had started one of those laser companies that I had worked with as a consultant called Coherent back in 1977, and drifted from investing in semiconductor equipment and semiconductors and software into the healthcare business in the early to mid 80s, and I've been doing healthcare investing since then. I echo a couple of things that Barbara has said. I think the technologies are, and I love technology, and my partners protect me sometimes from doing things in technology that don't have markets. But the technologies are continuing to develop. I think at a faster and faster pace. And for healthcare investors, the demographics are terrific. In the next 20 years, the demands of populations that have money for healthcare are going to be huge, and they aren't going to go away. And at some point, information is interesting, but a new knee, a new piece of cartilage, an extra 10 years of life that is pleasant to live is going to be really valuable. And people aren't going to think twice of spending $10,000, $50,000 to do that. So the economics, I think, are terrific and getting better for our business. How we make money in that is changing a lot. The cost of bringing a product to market and the willingness of public investors and pharmaceutical companies to share that risk of bringing that technology public has started to go. The cost has gotten pretty dramatic, and so the risk for these early stage companies, I think, has gone up dramatically. It's not that the technical risk is higher or the commercialization risk is higher. It's the amount of capital that's required to realize it has gone up so much. So that's I think what we're dealing with is how do we develop these technologies and get them to market in a way that there's some leverage for the entrepreneurs and the early stage investors.
Thank you. Jonathan.
My name's Jonathan MacQuitty. I did a PhD in chemistry in the UK. I worked in commercial research and came to Stanford in 1980 to do an MBA here. I joined Genentech in 82 and then to Genencore in 83, and then I ran I was CEO of a biotech company for 10 years and moved into venture capital in 97, and I'm now a general partner with Abingworth Management, which has 4 offices, 2 in the US and 2 in the UK, and we invest about half of our funds in the US and half in Europe. So we get to see both sides of the Atlantic. And I think conditions are currently pretty similar on both sides. In terms of how I see the industry right now, if you looked at the large caps, you'd say things were doing extremely well. I mean, Amgen is the 34th largest company in the world. Its market cap is $80 billion. It's done extremely well. If you went back at different periods in Amgen's life, there would have been people who would have been surprised that it would be worth $80 billion. An interesting exercise for Mark would be to look at the year-ending market cap of Amgen over the last 20 years, and I suspect you'd see a hockey stick, where most of the value was in the last 5 or 10 years. So the large caps are doing very well. The mid caps, having raised a lot of money over the last 3 years, are also doing pretty well. It's in the small caps, and particularly the private, later stage private companies, where there is some sort of anomalous behavior. I think a lot of that is due to the fact that the venture capital community has this interest, I think the correct word is fetish, okay, about being in the A round of deals, okay? And so we see a large number of companies. I mean, some venture capital firms go to people and say, we are only in A rounds. We never do later stage deals. And so what happens here is you have this sort of negative yield curve that Mark showed on the thing, where you actually get a flat, or in some cases, a decreasing step-ups over time. There's this reluctance, okay, for people to invest in C and D rounds, okay, which means and an aberrant interest, okay, in terms of investing in A rounds, where you end up getting, as I say, this negative yield curve. If you factor in the time value of money, and it is the most irrational behavior you can possibly imagine. I just can't imagine why people do that. We actually do a lot of later stage investing, and we see some fantastic opportunities, I think, as a consequence of that. I do think that the rest of the industry is sort of eventually working out that they can't do just A rounds, okay? And there will be an arbitrage here, and eventually prices will start to come back into line. But I think that is part of the reason here. Mark alluded to the fact that this is exacerbated by the fact that the IPO valuations have decreased, okay, if you go from the last cycle to this, and the average amount of money put into venture-backed firms has increased. So you're seeing companies raise $100 million privately and going out at a pre-money of 200. Well, if they are successful, you've just capped your average return at 2x. Okay, I mean it's a very silly way of doing things. You either have to put a lot less money into it, and one of the models out there, Mark alluded to sort of the business model problem, is what I would call NERDOS, no research development only. The idea that you don't need a platform, and what you should do is just have a lot of products in the clinic. Well, if you do that, and given the fact that pharma won't pay for things until after phase 2 data is available, you basically have a situation where the company is funded entirely on equity dollars. Okay, why do they need $100 million? Because they're not going to do what Amgen or Genentech did, which is to go out and do deals with Lilly or whoever it was, who helped provide non-equity dollars for what they did. And so we're in a situation here, and the big funds, we have billion-dollar life science only funds who love to write checks for $100 million. It doesn't bother them at all. The problem here is it dilutes the average return significantly when you give companies so much equity dollars. One of the reasons that we kind of like platforms is that you don't need, you have customers right away. You don't need a lot of equity dollars. And we actually see that the best returns in our portfolio coming from platform companies who actually don't need a lot of money to be successful. And of course the ideal, and we have some of those in our portfolio, are ones where you can do both. You have platform and you have products, and you use other people's money to support your products. And then you don't need a lot of money, and you still have the upside from it.
To turn this to practical matters right away, I wonder if you would mind going back through with what you're interested in today. What are you investing in? What is getting funded? And maybe if you would distinguish, at least as polar extremes, enabling technologies and what you like at that end, and then maybe the nerdo and what you think of those as Jonathan has done. What are you investing in or looking to invest in today?
Well, I've done this for 2 weeks, so I haven't really...
Okay, you get a pass. I'll get you on the technologies.
But I'll come back and talk about what I would invest in. I would defer to Jonathan. Well, did you want me? I can say the things that what I'm seeing and I think drives interest. It's funny, TPG Ventures is an unusual venture firm because you're taking a group of people who are very good clinical developers and pharmaceutical industry executives and asking them to make investments. So our predilection is more on the sort of technical aspects, and I think that's how we tend to work in syndicates with other people. They look at us for sort of technical and operation type of things. So what do I look for? I think first and foremost, biotech companies are successful because of their management. So I think I focus a lot on who the people are and whether the gaps within the organizations as they present themselves to us are actually fixable with a reasonable amount of time and effort. I think on the technology side, I think we're resetting the clock a lot. I think there's a tremendous amount of investment that was made in the 90s. Not all of it was bad. And I see for us, we're looking for ways to create the necessary integrated capability to create a functional platform that will really leverage the investment that has already been made. I think the areas where there's tremendous potential value in terms of things, I think the antibiotic industry has certain attributes to it that should be really looked at. It's the only, most pharmaceutical sectors. You always have to, if you're going to justify premium pricing, you have to demonstrate superiority to existing generic therapy. But the emergence of resistance, particularly driven by over-the-counter use of the drugs outside of the U.S., and particularly driven by what's happening in community-acquired infections, where we're actually seeing increase in morbidity and mortality in the populations, in the face of the fact that pharma, for a variety of reasons we can discuss, sort of walked away from infectious disease the last couple of years, creates a tremendous opportunity. And it's one of the places where I think the fruits of the Genome Project will have an immediate impact. Another area we're looking at technologies, I think in the biotherapeutic side, anything that impacts cost of goods. I think antibodies have tremendous applications outside of the current areas of cancer and inflammation, but if they're going to be used for chronic applications, you can't be spending $25,000. And I think there's a lot of issues around cost of goods and manufacturing alternative protein therapeutic platforms, which are extremely useful. I think there are viable models out there today for pharmacogenetics and pharmacogenomics, that is the use of evidence-based medicine, and I think linking that to clinical development is another area of tremendous interest, certainly to me right now. And I think anything that deals with the overall problem of predictability. I think the real issues in drug discovery, putting drugs in the clinic and putting them on the market, is a fundamental lack of predictability. We have a tremendous amount of technical success, which does not link right up to progress, and to the extent we can actually deal with that attrition problem. So anything that works on the predictability angle, mostly in this transition between animal and human models, I think is extremely important and are areas that certainly we would invest in. I think the last factor that we're looking at very hard is globalization. This is a global pharmaceutical market, and I think we need to be connecting. We need to look outside of the U.S. more to build more international-based companies, so we can align technology, cost of capital, cost of labor in a much more effective way, and leverage across the entire world as opposed to just across this thing. So I think you'll see us doing things outside of the U.S., not just inside the U.S.
Good, thanks, Jeff.
I will make some comments. Most of them will be on the medical device industry, but let me throw out some data on clinical trials, which are where the big money comes into biotech companies. The average cost of a clinical trial reported by Tufts is about $850 million. Now, we finance companies, this industry finances companies without the dry holes. But you're looking at hundreds of millions of dollars. And the companies that we finance tend to need to contract out their clinical trials. And when they do, they go to the CROs. And 75% of the money in the CROs are spent by big pharma. And you wouldn't be surprised to learn that we get the second and third teams. And so one of the things that happens, especially since we as investors look at clinical trials as a financing event rather than a scientific and performance event, is that we get started fast and we don't do them particularly well. And so we are particularly sensitive, and I suspect others are as well, to clinical trials that are in process because of the factors that I just discussed. The similar analogy in medical devices is, do we cover launch risk? And I'm sad to say that most of the opportunity that we are excited about are companies who failed on the first time. What you will discover if you look carefully at medical devices is that as an industry, we have not had a successful medical device launch since the mid-90s on the first time. And after the first time, there's some Darwinian stuff that happens, and some companies don't make it. My colleague here was saying one of the things that's different in biotech, if I can quote you, than devices is it's like your child. If they fail the first grade, you send them to the fourth grade. I mean, if you fail the fourth grade, you send them to the fifth grade. And there is a tendency in biotechnology to give them the chance for the fifth grade. In devices, getting to go to the fifth grade when you fail the first time is much harder. And in the device industry, there are two pieces of sophistication that have been happening in and around marketing. One is that the larger companies are doing significant direct-to-consumer market demand stimulation through advertising, And doctors are working more and more as production line workers, and the more noise they get from consumers, the less time they have to spend on our new ideas. And as an industry, we haven't figured out how to have an organized, relatively cost-effective way of stimulating consumer demand. And our competitors who are out there trying to get doctors' attentions are doing it pretty well. An analogous factor is that there are 750 payers out here, out in the world, the reimbursement agencies, who decide the speed of the launch. And the larger companies have gotten extremely sophisticated about touching them in ways that give them a reliable launch. And we as an industry are, in grade 1 about how to do that. And some of the opportunities that we are excited about are the second launches. They failed the first time. They're realistic. They're going to do it right this time. Some of the people have stayed and they've learned what they need to do. They started doing the things they need to do to the payers, which take 2 or 3 years, and they're underway. And those are some pretty interesting opportunity. The one that you might look at that has that characteristic that's a successful company today is Cytec, the new way of doing pap smear companies, which did extremely well on its second try. So those are the two things that we look for. And to answer the fetish about Series A, the way we say it in our partnership is, given the way the model is, there are going to be crushers and crushees, and we'd rather be the crusher than the crushee. And the reason I say that is for you all to think about it, because when you put your time into an early stage company, you are basically making an investment by taking a compensation level that's lower than what you would take if you worked in a big company. So you are making an investment, and you can only make that investment once you've decided to take the lower compensation. You can't go into the D or the E or the F round with a bigger dollar amount. So you're very much in the place of the early stage investor. And when you look at the things you want to do, I think it's important to think of yourself as an investor with limited capital and think about capital intensive companies and what happens to the early people if all doesn't go well in an increasingly complex world. I'm going to hope somebody else said something more cheerful.
Well, let's see. I guess I would classify myself as a crushee then. And actually, for the entrepreneur, it's not as bad as for the investor, because as long as the entrepreneur is still around, if you get crushed, the capital gets crushed, but the entrepreneur typically gets some more options, and they go forward and they get re-upped. So the real crushee is me or other early stage investors. And I think historically why there's been so much early stage focus is because the venture capital community has been populated by either technologists or ex-company founder CEO types. That's where a lot of the original people in the industry came from. And when they got into the industry, they did what they like to do. They like to either start companies, because that's what they did before. They started and built a company. Or they like to develop technologies, because that's what they did before. The industry's grown hugely since then. So there are still a bunch of, old anachronistic guys like us around. But there's another breed that's basically looking at, okay, you can start a technology firm and so forth, but how do you actually get it to really grow and take over a marketplace and get that technology commercialized? So I think there's a balance now in the industry of people who start things, who invest in second and third rounds. There probably aren't enough mezzanine players yet, but there's a lot of capital being raised to do late stage biotech investing right now. I think that there are at least 4 or 5 firms that are newly formed to do that. Sprout is raising a fund just to do that. So there is a mix of funding sources out there, although I do agree that the later stage funding is tough to get sometimes. And so as an early stage investor, we look really hard at the capital commitments that are going to be required of our companies going forward, so we get crushed less often than historically, perhaps. In terms of what we're looking at, I think that probably the easiest thing to do is say, what have we done? Because it's concrete. So in the last 12 months, we've done 5 companies. And one of those is a is a drug delivery type company that takes known drugs that are known to work in the blood in a certain way. They are typically off patent. They are typically act on the nervous system, so the time to activity is important, and it's a way of getting the drug into the bloodstream very, very rapidly, which doesn't involve injecting a bolus. So that's one. And obviously the reason we're interested in it is if it works with one drug, it's highly likely it will work with several. So we can sell the first one to a pharma company or something like that and finance the rest of them for ourselves. Two of the companies are in the medical device area. It's an area that we, as well as a number of other investors, continue to invest in. And the reason we like it is because the capital requirements are relatively limited. Unlike a biotech company that might require $100 million or $80 million or $200 million to get to market, the cost of getting a device company to market is a little more understandable. It's really a technical risk. If the technology works and it works in the clinic, the cost of that can be mapped out pretty clearly. And there's also one thing on the device side is that there are a group of companies that have historically bought small device companies early in their development. So you can get a device company to the point where perhaps it's being used by a couple hospitals, a few docs. So you've gone through the clinical trials, you've shown it works. So perhaps you've been crushed along the way when the first thing didn't work. But at that point, there are device companies that want to buy those companies, and this is a market that, and it's really very collaborative. In many of our device companies on the second round, we have one of these purchasers buy a chunk of the company. They don't get distribution rights or anything like that, but they buy the company. They call us often. They visit our offices. They visit the management teams while these clinicals are going underway. They commit on the clinicals. They say, well, if you did it this way, it would be better. Because they don't want to buy the company before the risk is out of it, but once that risk is out of it, they have a sales force, a distribution force, a group that deals with reimbursement, and they can take that product, put it in there, and there's been tremendous successes and a long history of successes there. That hasn't really existed on the biotech side yet, perhaps because the costs are higher, but it isn't that symbiotic relationship that I think on the device side we have. And then we've done two platform-type companies, YIPes. One of them is in the area of producing things that bind to proteins more rapidly. So you could think of it as an artificial antibody company. There have been a number of these in the past. Most of them haven't worked. We hope this one does. It's got some very bright people, and it allows you to biologically engineer a new class of compounds that bind very tightly to proteins, which we think will have uses both in therapeutics as well as in diagnostics. It's an area where we've broken our pick before. We had a company in one of our prior funds that was also trying to solve much the same problem. We found out that didn't work very well, but what we did find out was the demand for that was extremely high, partly because of the cost of manufacturing monoclonal antibodies. There's a lot of patents in the monoclonal antibody area that are also costly. So yeah, it costs you to make it, and it costs you to license some of the production techniques. So what we learned was the market was really good. Our first attempt technically didn't work. That was painful. But when this technique came along, we were able to immediately introduce that company to potential early customers, and within weeks of founding the company, we could go back and say, well, our last company didn't work, but look at this technology, and we got a very good reception on that. The other platform is a company that is looking at using biology to modify inorganic compounds like metals and things like that, and silicon and stuff like that. And I frankly don't know what we're going to do with it. It's a research project. This is a research project that we knew we were getting into when we went into it. The amount of capital is relatively low. We have multiple co-investors in this company who also recognize that it's a research project, and that we're going to probably have to invest several times in this company as it matures before we understand what the actual application is. And the entrepreneurs understand that it's a research project as well. So they didn't come to us and say, we need $20 million and then we'll figure out what to do. They said, we need about $2 million and we've got about $2 million of government grants, and we're not going to go take it out of the university right away. We're going to use the university, because the university has all this wonderful equipment that we don't want to have to buy. So the key thing was the entrepreneurs and the backers understood the capital requirements, the time requirements, and have agreed on that ahead of time. Whereas if we put in money and the entrepreneurs thought that this was going to be a very quick out, we would have an immediate mismatch of our expectations. So the expectations are the same. Other things that we're looking at that we haven't done, there's a lot of specialty, and the industry is looking at. You might talk about specialty pharma, but specialty pharma is a big deal right now, partly because the exits are there for specialty pharma. You can get some compounds that you think are either under the radar of the big pharma because they're $200 million products, and big pharma doesn't care, and you can buy them. Or that you have a particular expertise in developing them less expensively than big pharma. There are quite a few of those companies being funded, partly because you can get phase 1, 2 data, and that's what the public market is interested in. We have not played in that area, but a lot of people are. There is renewed interest in diagnostics, both in genetics, genetic diagnostic as well as protein-based diagnostics for personalized medicine, and there have been a number of companies continually founded in that area. It hasn't quite happened yet, but there's still ones being done there. And obviously pharma development, discovery, whether it's based on new targets, new compound approaches, structurally understanding the targets better to be able to modify them. There are continue to be companies founded and backed in those areas.
So before I forget, let me talk about specialty pharma. Craig mentioned a lot of people are very interested in specialty pharma, and the reason for that is because, you know, all 8 of the companies that have gone out have positioned themselves as specialty pharma. One of the things that we find very odd in this industry is that the venture capitalists seem to be use momentum as a philosophy for investing. And momentum is a great thing for a day trader or an hour trader. It is actually not a great idea for people whose average holding period is 7 years. So, you know, it just seems to me to start a specialty company now, okay, on the chance that in 4 years' time that will be the flavor of the month, seems a flawed strategy for us. One of the companies that went out was a specialty pharma company that we actually were in the A round, Pharmion, 4 years ago. And when we started, I can tell you, it was not the flavor of the month. We weren't doing genomics, we weren't doing proteomics, and people thought we were nuts to do a specialty pharma deal. Okay, it was a great team. We backed it because we thought it was a good business, not because it was, the flavor of the month. Quite coincidentally, about a year ago, we were in a round of a genomics company. And people say, what are you doing? Why aren't you doing specialty pharma? We seem to end up being mildly contrarian. I mean, you don't sit down every year and say, oh, let's be mildly contrarian. But we end up doing that. And the reason for that is because the industry just gets this, we're dealing with a very complicated set of problems here. I mean, this is not like, with all due respect to Texas Pacific, where you go in and buy a division of a company and you can send a team of 14 people and, work the thing out to 8 decimal places. We're dealing with very squishy, soft kind of things, okay? And it is very, very hard to work that all out. And so what people try to do is they try to get some quick solution which doesn't require, detailed thought. And so they say, yeah, it's genomics. Oh, okay, great. Or, yeah, it's specialty pharma. When, of course, that is a very simplistic way of analyzing the problem, okay? The genomics and proteomics companies that, started early on, we were not interested because we didn't see how we could make money out of them, okay? We invested in one now because they have a very sensible commercial plan and they're making tons of money. We like that. Same with the specialty pharma business. I would say right now, people come to us and say, we've got a great phase 3 product and we want to start a company. And our reaction is, that seems very odd. There would be a great phase 3 product lying around the street that somebody hadn't noticed, okay? So, we're skeptical, okay, of specialty pharma. I'm a technologist and I'm an entrepreneur, so I love to do early stage stuff. And I would say about 2/3 of what we do is early stage. But we're very, very selective about what we do in the early stage. And I would think just right now, particularly selective. If there's an analogy here with IT, there are a lot of chess prodigies. There are not a lot of bridge prodigies, okay? It takes a long time to get the experience to be good. And we don't have 22-year-olds on scooters in our companies making brilliant, maybe that's because we're not the right companies, but I don't know many people in the biotech industry who have that kind of thing. So we have a different kind of business here, and we find that experience is extremely important. And so when we look at a new deal, what we're looking at is, as Jeff said, what is the quality of the management, largely scientific management if it's a very early stage company. What is the quality of the management? Do they understand the business? Do they understand how difficult this business is? And is it a nucleus around which a truly stellar team can be built? That's the number one thing. The secondly, we look, is there some kind of differentiable technology here? People have said, well, the problem with platform is you can't drag value out of pharma. Well, it depends on having something that pharma really wants and they can't get anywhere else. And we have a couple of companies where reluctant pharmaceutical companies are paying huge amounts of money because they cannot get it anywhere else, okay? So I think you have to look at these things and see how you're going to compete in what is a rapidly shrinking customer base in the pharmaceutical business. Areas that we like, we invest in drug discovery, we invest in antibodies, we invest in genomics and proteomics, instrumentation, devices, bioinformatics. We invest in lots of different areas. I think what we're focused on is not whether that particular area is popular at the time, but whether you have a truly stellar business plan and a truly stellar team. That's the thing that will make us invest.
It's been said a few times, and finally I think it got into my head that maybe this is right, that there's not only a sort of a balance or tension between fear and greed on the investor side, there is for the entrepreneur as well. And the comment that struck me recently was at a panel like this where a VC on one of those very big late-stage funds said, putting so much money into these companies, or even the prospect that what you're as a founder embarking on is going to cost so much money, has perhaps surprisingly swung that balance in favor of fear on the entrepreneur side, that you're raising more money and damn the dilution, whereas in the past you could really rely that, as Barbara was noting, that the entrepreneur would have common cause with the early stage investor, and the greed part of, take as little money as possible because then my shares are worth more, I'll own more and make more, would win out. I guess the place where I'd be interested in comments, if anyone cares to give them, is that at least on the biopharmaceutical side, we've seen a lot more money has gone in with liquidation preferences and everything else. I mean, it has been historically the case, and perhaps conceptually a necessity to sort of take your company public just to shake free of all of what is ahead of you if you're the entrepreneur. So you've raised a lot of money. The way liquidation preferences work, if you haven't sort of encountered them yet, is if you've raised $80 million and you have a private transaction, all other things being equal, the money goes back to the investors and then they get 80, 85% or their ownership, whatever their ownership is in you. So it's a double dip, which is to say, to make that go away and have your share be worth a share, you have to be post-IPO. And so unlike devices, and Craig's point, there really haven't been too many brokered marriages with partners that most would call successes all around prior to an IPO. So, I mean, have we created a fundamental flaw in the system with clinical trials and everything else, and even platforms costing more than before, and yet entrepreneurs no longer being the reliable advocate for taking less money and doing it with Duplo rather than Lego?
I would argue, so I'll take about a 12-year view of this because both being an entrepreneur, and I sat at the advisory board for Atlas for 7 years before this, there aren't the same, an entrepreneur in biotech is a different species than an entrepreneur in IT and other related industries, because both Atlas and TPG are balanced funds. I think it's very rare to see someone with fire in their eye and fire in their belly coming into your office telling you they're going to change the world. I mean, this has been the biggest surprise to me in the last couple of years. You're more often than not, I think the better venture capital groups seem to be seeing opportunities and trying to coalesce people and herd them around and create the companies themselves. Maybe because we're all frustrated entrepreneurs, but I think there's a sense of that we recognize that it's about integrated capability. I think your analogy, I like to use the analogy of a symphony orchestra as opposed to the chess to the bridge, but I think we're all saying the same thing. So and you tend to be biasing towards more experienced management teams than that. I think partly because there has really not been one of those day and night types of technology that has dominated the biological space. It's always been incremental changes that have aggregated together to lead to things. I think the same is true on the device industry. And if you look at the technologies that have changed the world, PCR, that has never been one company. It's been many companies. And so I think, for every Affymetrix, which is probably the rare example of a single technology really flipping a switch, I think 99% of the time it's about that aggregation. So I don't think there are the kind of entrepreneurs you're used to thinking about that are made excited, in movies and things like that, because it's a much more, wouldn't you agree, Jonathan? It just seems much different now.
The absence of mezzanine investors means that financing risk is a huge concern for an early stage entrepreneur. And the way they get around that is they take in boatloads of money. And the problem with that is that you're diluting your average return. And so I think it is a profound problem. I think most entrepreneurs have worked out that they aren't the ones taking the hit.
Right.
Because, if you look at these companies that are going public, within bounds, the amount of common stock owned by the management team is not going to change a great deal. We're not big fans of liquidation preferences. First of all, trade sales in the biotech side are much less frequent than they are in devices. Devices, I think that makes a lot of sense. But you don't get a lot of M&A exits, and if you're going to have an IPO exit and you're going to lose the preference, why spend so much time doing it? Particularly when it can set up misalignment between the management team and the investment group. So, I think. I think it's, this sort of absence of mezzanine funding does make it very difficult. And I think, there are a variety of ways of dealing with that. One is to, set up models where you don't need to raise quite as much money, okay? And you mentioned some of your companies which are designed to do that.
The question about why we aren't seeing more highly valued exits through mergers with larger companies is driven off the public market, because the buyers in the large device companies and the large pharma companies, they work off the cost of financing on the private side and on the public side. And when the public market has is paying the same range of price, but they want a much more mature company, the mezzanine money is coming in at a quarter to a half of the expected IPO price. And whether it's a quarter or whether it's a half is more important than whether the expected IPO price is 350 or 380 million. And the people who buy companies know that. And so they're looking at your alternatives. And unfortunately what happens, I actually think the preferences have been very damaging to this industry. Because what happens because of the preferences is that investors argue about the preferences. And the hamburger is as big as the hamburger is. And arguing about the preferences often makes the hamburger smaller. But what happens with the preferences, and I think one of the reasons why you see many more crushing financings when, if you looked at the business plan as a smart MBA, you would say this company should be sold, is because when the larger company offers the amount of money that all the investors don't like, they default to raising money. And by the time they've defaulted and they find out what the terms are, there isn't time to go back to the big company and take your lumps and sell the company for that. So we're not seeing very many exits because the valuations are low. But the reason we aren't, in many cases, doing the intelligent thing is that you can't dual process raising money and selling the company. You've got to do one or the other. And the characteristics of financing a company is that you can stay optimistic much longer.
I think it's a good point. I think it's one of the great myths in biotech investing has been the myth of the pendulum. People don't change their investing, don't change the style of their funds because the pendulum will come back. And I think the minute you use the word momentum, but I think that's a lot of what it's about. If we can get rid of this idea of the pendulum and people start reacting as business people, I think some of this will go away. Because I think you're right. A lot of the failure of M&A is ego, not good business sense.
Well, it's misalignment of it's not just misalignment between the management team and the investor group, it's misalignment within the investor group.
Right, absolutely.
Okay, so you have early stage investors who are not going to benefit greatly from an exit who say, let's roll the dice and go again. Whereas when you look at the whole thing on a macro basis, that's not the right decision.
As long as there's capital around, the people will go again, they'll do it.
Right, exactly.
But the point I'm making is when they make when in some of the companies I've been involved with, when the investors make the decision, their idea of what the financing will be is mythical. And so they do a choice between A, which is relatively certain, and B, which is usually about double what it's going to turn out to be. And when they go for B, they've lost the opportunity to do A. So that's a part of how the preferences work.
Well, I think a common theme that's been here is that all of us tend to protect management if we believe in management against the subsequent rounds. I mean, there's a re-upping of management if it's good. There's a tremendous protection of that, more than the protection for the Series A. So management is
as
probably...
long as they're still there.
As long as they're still there.
Right.
One of the interesting things in the environment I live in is I get to sit through big discussions about LBOs as well as venture capitalists. And the LBO guys do have this idea, which I think we should really think about. They call it the killer bees. They said the worst management team in the world is not the C team you shoot. It's the B team, which is sort of just good enough. And and they really have this huge time to money. So I would say that I will overpay. I've been overpaid as a manager, and I think the industry will overpay for people who have the skills you want. The problem is the lack of people with the skills you want, and the lack of the discipline, the investor's part, to actually wait around to make sure you actually have those pieces in there, or not superheat the company with funding, which is what a lot of what happened in 2000 prematurely. I mean, it's almost remarkable. The most expensive money you're going to spend is Series A, Series B money, and oftentimes that's put in the hands of the people that you are least trustworthy of. And so I think management is everything, and people will overpay.
Our Artcom Misadventure at Recap, which has been around for 15 years, we thought, great, the SEC is now forcing infotech companies all the way out through Palm to file their contracts, which before, about 99, was a rather unique and, for me, lucrative aspect that distinguished biotechnology, because the cycles were so long, because it took so long to develop the drug, and we raised money publicly when we could. So often the SEC kind of took a dim view of this entire phenomenon and has forced this industry to file their actual contracts. And so I've made a nice business out of collecting all those and selling them to interested parties. But again, infotech fell down that same pattern for at least about 2.5, 3 years. And the controversy I'd like to put in front of you is we just sort of took our rule book and applied it to everything from software and hardware and telecommunications to WWF, and grabbed everything that was in there, did valuation histories, created about 1,000 valuation histories from first venture financing to wherever, matching up to 650 that we have over the 25-year history of biotech that have been venture adopted and have gone somewhere. And I'll tell you, when I look back not too long ago, over half of those 1,000 are gone, flat out, dead, just disappeared. And I don't mean rolled into other companies with an exit for the VCs. By contrast, in biotech, there have been maybe 35, 40 sort of real resolutions of the kind of down, hit the pavement, nothing came out, rather than sort of consolidation and wind up. It is really hard to kill off a biotech company, it turns out, at least over the long view. And I put it to you, maybe we're coddling folks a little too long and keeping those killer bees around forever. And the point is, or at least where I would put an edge on it, is if management is going to be made whole, even if it's a very dilutive round, if their own sense of fear is what's motivating them rather than, I don't want to issue another share, maybe they go after 4 projects rather than their best 2. They sell the first 2 if they have to sort of meet an objective. They keep the next 2, which are the lower quality ones, and we're dumbing the thing down again and again. Is that a real systemic risk, I put to you?
It's a lack of best practices. I mean, I think that's what I think it is. The boards have to be more responsible about how they treat the management and vice versa. If you keep supporting the killer bees and you keep financing what otherwise is not going to work, you get what you pay for.
Well, yeah, I would have a different view, and that is several things. One is I think that actually if you looked over the last 2 or 3 years, you'd have seen a lot more bankruptcies in the biotech industry than you saw in the prior years.
Sure, so we're now noticing them. Before they were just non-existent.
Yeah, I think the reason is twofold. One is biotech companies in general are developing pretty interesting IP. And even if they don't continue, there's normally an exit that can be arranged where someone wants to capture that IP. If you're, a search engine which is doing a lousy job and you don't have many customers, it's amazing how you're not worth anything to anybody. Okay, so there is a difference in the biotech industry from that point of view. The second thing is, this is such a roller coaster business. If you look, you take something like Gencia, they're 15 years into a pretty successful development, and they open the envelope, and the envelope is you're worth nothing, and so you don't really get that kind of swing in an IT firm.
Inside us,
yeah, you might be 20% up or 20% down, or but you're not going to lose $3 billion of value in 4 minutes. Okay, it's very hard to have that kind of roller coaster, and of course on the upside, they asked the CEO of Biogen to come and talk to an M&A panel to encourage biotech. This was Jim Vincent to do to be more susceptible to M&A. And so in the Q&A they say, well, so how close to the edge did you get, Jim? Oh, we got down to about 7 days cash. So I mean. So what do people do? They keep rolling the dice. They keep rolling because it worked. Okay, and so the problem here is that you do have these events where you capture a lot of value. I look at my own company. We had a negative net worth. The end of '95, and we're worth $2 billion 5 years later. It's that kind of business.
I think the other thing is that you have to distinguish between good technologies, good products, and good companies.
Right.
And we're all, or at least I am, guilty of trying to start companies around technologies that really aren't really a company.
Project.
They're a project. Or to start a company around a product which really is part of a product line, but is not really a product. And so these companies are doing things that are really very interesting. I think that's the reason we're all here. And they may not be economic on a return to the investors or on the time to the entrepreneurs, but what they built has value to someone. And they've either built data that's useful to other companies in the area, or they built an instrument that can be folded into another product line and be successful there, or they've made some reagents that are in trying to do something else that have value. And so when these companies don't go away, the companies go away, there's value that's lost. Mm-hmm. There's equity value that's lost. But the technologies continue in another form. On the IT side, and our firm does both IT and healthcare, a lot of things that are tried are completely circumvented by other technologies coming along or other software coming along. And so the value that has been built is very ephemeral, and it doesn't tend to have, you don't have the ability to sort of take a really interesting chip that runs at 10 megahertz. When one comes out that runs at 20, the 10 one has no value. It's not that it has less value, it has none. And that hasn't been the case with many of the research tools or other technologies that have been developed in the biotech area.
It is the fact that there's a controlled price, but a successful team's ability to sell more of the stuff is much more important than the controlled price. Obviously it's price times quantity, but the difference in a launch is much less tied to price than to quantity. And so while it is the case that there's a controlled price, the difference between getting 3% of the market and 25% of the market is much more in management's hands and is a much bigger driver of success. Because ultimately, you can always if you can sell the thing, you can always figure out how to make it at a price where you're going to have a nice margin.
I think there's a huge inherent conflict in healthcare. Is it a human right? Is it a commercial business? And I think that's the conflict you're seeing. I think on the pharmaceutical biotech side, the largest margins you're ever going to see are highly differentiated pharmaceutical products. But that puts a tremendous burden on you as an entrepreneur to make something that's truly differentiated. So the problem right now is that a lot of things are generic, and like I said earlier, you got to be better than the generic to get premium pricing. And from the government's point of view, a lot of things that were once prescription are now going to go over the counter because over the counter drugs are not paid for by third-party players. So that puts a bigger premium on innovation if you're going to command the kind of multiples, quite frankly, you see in this industry. So hopefully, that will drive us to do innovative things. That's part of my disappointment. I think some of the specialty pharma market things because it's anti-innovative. These are products which the market has already said no to, and someone's trying to squeeze them to a perception of being a big product. This is an industry that needs to be innovative to be profitable because of the command pricing you're talking about.
I would just say on a macro level, first of all, healthcare represents 15% of the GMP, and in fact, if you look at GMP and the percentage allocated to healthcare, it's steadily increasing. Okay, the ones with a higher GMP spend a higher percentage. So what that means is over time, not merely do you get the GMP increase, you get the fact the percentage increases as well. So you have this huge ramp where the amount that the US spends on healthcare today, once that translates to other parts of the world, this is going to be a way big business. Okay, and if you look fast forward 50 years, healthcare is going to be, a third of the economy or something. It'll be a huge number. Okay, so on a macro level, this represents, absolutely staggering numbers. To be successful here, I think, as Jeff says, what you have to do is you have to get differentiation. Okay, and I think that part of the problem is that the kinds of things you can do in other industries to get differentiation, which is sort of advertising and that although there's going to be a lot of effort on that, the bottom line with this product is a technical issue. Okay, you either solve something technically or you don't solve something technically. Okay. And so, it's not like the car industry, so because of that, because it has that very, very strong technical basis, it's a very hard business to do well in. Okay, and that's why I think you need even more creative people to succeed.
There is, however, a ripple effect on the cost of capital. So, if you look back to the Bill and Hillary nationalized healthcare, and you saw a tremendous drop in the value of the large pharmaceutical companies, and a cutback in their R&D. Well, that ripples, that little ripple to them, a billion here, a billion there, to the smaller biotech companies and the companies that supply equipment to them was horrendous. I mean, they got wagged and we got whipped. So there is, but the concern wasn't that people weren't going to be willing to pay for it so much. I think the concern was people weren't going to be willing to pay for innovation. Right. And I don't know whether that perception was right. I hope we don't run the experiment. But what really hurt the entrepreneurial healthcare area was the concern that you are now going to have one person make the decision to buy or not. And it wasn't that they weren't going to be willing to pay for it, because I think you can probably mobilize the community to say, my daughter needs this, I'm going to buy it for her, and you have to pay for it. But the concern was they were going to say, we don't need that.
Pharma has really bad PR right now. I mean, and it's very true. When pharma gets a cold, our industry gets pneumonia, really. And if you think about it, this 15% of the GDP, drugs. If you look at drugs, it's only 10% of the total health care. But it's 51 cents of what comes out of your pocket, and a lot of the money is in the sort of health services side. And pharma's just done a really bad job of really exploring that and actually get the reality. Because when everyone thinks high healthcare costs, which is driving your control, they think pharmaceutical drug costs, but it's only 10%, 90% of the problem is elsewhere, and that's an industry problem on our part, because we can't be seen as the tobacco industry number two.
So here's one perspective on innovation. People always say, well, why you'd think, like having a cancer drug innovation, why is the FDA so biased against, approving things and biased towards safety? And to put it in very crude terms, dead people can't vote. Okay, and if you die of cancer, you're not lobbying people. Okay, and so what happens here? It's just amazing. Okay, that patient groups are as ineffective at persuading the FDA to encourage innovation as they are. They are extremely ineffective. With the exception of the AIDS community, I would say that the pressure on the FDA is universally to not approve things. Okay. And, if you ask them what was the FDA's shining moment, it's thalidomide. It's not approving something. That's what we want to do. We want to not approve things, okay? So they try to think of creative ways of not approving lots of things. How many people die from from cancer every year? How many people die from heart disease? I mean, I just find the political process amazing. And so, but in conversations with, people in Washington, dead people don't vote. So it doesn't matter,
There's an interesting statistic that the approval time when we didn't have a FDA commissioner doubled. It doubled. I mean, you can look at the
we solved that
years
problem
before,
by getting a new Jeff.
We didn't.
Getting rid of the FDA.
And now it's dropped back down again because no one at the FDA gets a kudo for approving a drug. But boy, do they get creamed if they approve a drug that one person or 10 people die. I mean, that's a career-ending event. So the reward structure of the FDA, unless you have someone at the top who's driving them to move things through, is not to make a mistake. And a mistake is putting something on the market that kills somebody, not putting something on the market that saves somebody.
And I would make a point that's related, which is that the mobilization of the patient populations has gotten just as important in marketing as it's gotten getting through the FDA. And we as an industry are slow to understand that the way you solve the FDA problem is to mobilize like patient the AIDS groups. Population, and the way you solve the reimbursement problem is to mobilize. And to start the market strategy early about how to do that and understand that it's expensive because there are two pieces of the same coin, which is there are almost no products that aren't well reimbursed, quantity and price, if the patients in any large numbers care. The drug-eluting stent would be the one that would leap into your mind. The $4,000 test to see if you're one of the 5% of people who might be predisposed to have breast cancer, that if you have it, you're going to die anyway. Those are the ones, when people care, they get reimbursed at very high prices, and when they care, the regulatory barriers are less. But the industry has not, has not figured out how to mobilize that. And fortunately or unfortunately, the larger companies are mobilizing it well. So our poor efforts fall on people whose mind share is already taken up with people who are doing it well. And that's a much bigger issue, I think, than control pricing, by a lot.
Is that what you meant when you said that if the volume is there, we'll figure out how to sell it, we'll figure out to make it the price for the margins are maintained?
The first reimbursement decision is, will we pay for it at all? And as Craig said, the way you get killed as a company is the answer is no. Once you get, we'll pay for it for some people, then it's like, you figured out how to beat the enemy, and you're just in one trench after another. It takes a while, but once you can get that we're going to cover it for some people, you can work out the value and you can work out the other people. But
this is a very important question. We've made, I suppose, somewhere between 80 and 100 investments over the last, 15 years. And we only had 3 companies go bankrupt. One of them we invested in after they'd got FDA approval for their product. But they didn't get reimbursement.
And it's
not good.
It's multi-year. It's what the larger companies are doing is they are figuring out what their income, health economic studies are. They are designing them. They are taking them to a representative sample of payers. They are asking them if these will win the arguments, and then they're doing the studies. Unfortunately, the tranche investor, the way we finance companies, which is performance point to performance point, is very poorly suited to that kind of multi-year endeavor, unless we make it a financing event. And if we make it a financing event, it drives up the cost of capital. So it's a very sophisticated process. Another permutation is that the kinds of scientists who want to do the does it add quality of life, does it save money studies are not the same ones who want to help you with your big molecule. So you need a different set of scientific advisors who are willing to do work that isn't as scientifically interesting, but it's work that makes a successful company.
This is what I meant earlier, about that the key to this industry is the creativity on the technology side has to be matched on the commercial side, because there are just a lot of really interesting products and things like that which are sort of trapped in this sort of reimbursement wasteland or lack of a regulatory roadmap because it's never been approved before. It's always a catch-22 FDA. And I think getting that navigation done early and in parallel with the technology side will address some of that mismatch.